Hi, my name is Ali Kodadet, Head of Income Planning at CBS Brokerage. Today, I wanted to talk to you about distributions from non-qualified fixed indexed annuities, also known as FIAs. Before getting started, just wanted to turn around and mention that anything we mention here should not be construed as providing tax or legal advice. It is important for you to work with your client's attorney or CPA on any specific questions. With that said, let's go over how FIAs that have guaranteed lifetime riders will be taxed. Also important to note that the annuities that I'm going to talk about are going to be post-TEFRA annuities. TEFRA was passed into law on September 3rd of 1982. Anything that was pre-TEFRA has a little bit of a different tax ramification associated with it, but the vast majority of the annuities in the marketplace today are post-TEFRA, meaning that the earnings come out first. Once the earnings are depleted, then the basis is returned. Basis will not be taxed because it's already after-tax money since this is a non-qualified annuity. In this example, we've got a 70-year-old client that has $1 million account value. The basis is $600,000, meaning that they have gains of $400,000. Again, really important to note that this is not annuitization. As a result, Internal Revenue Code 72E is going to be the overarching rule as far as how these particular annuities are going to get taxed. In this very simple and easy example, we're going to go ahead and make one huge assumption, which is not accurate in the real world, but it's going to make it a lot easier for illustrative purposes. We're going to assume that once these distributions start, that there's not going to be any more interest credited to those particular annuities. It'll just make the math a little bit easier for illustrative purposes. So again, we start with $1 million, basis of $600,000, gain of $400,000. Based off of the life expectancy and the mortalities and interest rates, this client is going to receive $100,000 a year for as long as they live. So for the first 4 years, this client is going to receive $100,000, but this $100,000 for the next 4 years is going to be the gains associated with this account. As a result, the client is going to have to pay taxes on this $100,000 per year for the next 4 years at their ordinary income rates. As the client continues to live and take distributions out, for the next 6 years after the $400,000 has been depleted, they are going to continue to get $100,000 a year, but now they're eating into their basis. Since they're eating into their basis, the client does not owe any taxes on that money because it is a return of after-tax distributions that was used to fund that annuity. Should the client live long enough, they're going to continue to receive more $100,000 distributions, but now that they've depleted the basis in this example in year 10 is at 0. Any distributions that occur after that, again, they're going to continue to get the same $100,000 per year, but that is going to be deemed to be a taxable event, and that will again be taxed at the client's ordinary income rates. I hope this helps explain a high-level overview of how non-qualified FIAs with guaranteed lifetime riders work from a taxation standpoint. Again, if you've got specific questions, please reach out to the client CPA. If you've got general questions or would like to discuss this in more detail, please call me or reach out to your CBS insurance specialist. We're here to help you any way we can. Take care and have a phenomenal day.